Welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. The volatility in equity markets is starting to put everybody on edge. The volatility is, of course, reflective of the uncertainty currently facing the US and the global markets. And all eyes are on the Federal Reserve and what they're planning on doing in terms of being able to keep down inflation and also allow the economy to grow. And so we have a lot of concerns around what the Federal Reserve is going to do and how it's going to impact the overall markets, especially the bond market. To help us discuss this, today we have Jason Stuck. He is the Senior Managing Director and Head of Portfolio Management at Northern Capital. Northern Capital is a specialized institutional investment management firm specializing in fixed income specifically. And they work with a lot of firms like Atlas Fiduciary Financial in helping us come up with the best ways to manage fixed income. Steve, do you want to specifically introduce Jason?
Sure. And I've known Jason and worked with him for years, probably about 15 or 17 years. And we've always had enormous confidence in his ability to help us choose bonds and manage our clients' bond portfolios. And Jason has a bachelor's degree in business and economics. He has an MBA in finance from Northwestern University. And he's also a chartered financial analyst. In fact, we were just talking about it. Jason and I both became CFAs in the same year, 2003. We find Jason's one of the most knowledgeable people we've ever dealt with in the bond arena. So I guess we're going to start, Jason, with talking about perhaps your overall method in terms of structuring bond portfolios. And then we're going to delve into some details, right, about inflation, what the Fed's going to do, and so forth. So maybe begin by explaining to us how you create a structure bond portfolios without trying to predict which way interest rates are headed.
Yeah, well, thank you for that introduction, and thank you for letting me join you on this call. When we look at the bond market, a lot of people like to forecast. They like to think forward and say, well, what's going to happen with interest rates? Where are they going to go? And what we find is when we look at the professionals, we're not taking shots at them. They have incredibly talented people. They're some of the brightest people out there. But when they try to forecast interest rates, what we find when we look at the data is that a lot of times they don't get it correct. As you look back and you say, well, they expected rates to do this, but it didn't actually play out that way. So we thought there has to be a better way than trying to predict or make an educated guess. And so what we do instead is we build portfolios and then we stress test them. It's called scenario-based total return. And that sounds like a big word, big term, but all we're doing is we're taking the portfolio and we're looking at it in the future in a bunch of different scenarios. So what we want to look at is time and magnitude. When I speak of time, what I'm saying is let's look out 1 year, 2 year, 3 years from now. And so we have the time element. And then we also have an interest rate shock scenario where we take the portfolio, we decrease interest rates, so they go down. We run that scenario, which actually is possible. And then we also look at rates unchanged. So if rates stay the same over the next 1, 2, and 3 years, we look at that scenario. And then we also look at rates going up. And going up 1%, 2%, 3%. So even though the beginning of this year has seemed very painful, it is captured in our models when we're looking at things proactively. So we're looking at it and saying, let's look at this dynamically. Instead of looking at one scenario that could play out, let's look at a wide variety of scenarios. And let's build portfolios that are expected to perform over a wide range of scenarios. So the portfolio is expected to do better than something else if rates are unchanged, if rates go down, if rates go up.
So using that process, Jason, you sort of back into what the maturity should be on various pieces of the portfolio, what call features should exist, that type of thing, right?
Yeah, the beauty of bonds is they're fixed instruments. So you actually have, unlike stocks and other things, you actually have a maturity, a date that the bond pays off and pays you back. You actually have, most cases, there are things called floating rate or non-fixed coupons. But a lot of what we do is fixed coupons. So you know that you're going to get paid every 6 months with a coupon payment. And so when you have instruments like that, it gives you the powerful ability to actually run the math and look at these scenarios. And it's pretty accurate in its predictions.
And Jason, one of the things that I think we like so much about your overall process is that you go back to modeling and using science behind what
Yep.
you're doing, which is very, very consistent with how we manage the overall portfolio. We also believe that it's very, very difficult to really figure out what's going to happen next. We always talk about our crystal ball being a little bit fuzzy or possibly even broken. And the idea of setting our clients up in a portfolio that can weather whatever economic environment we're going to enter into. And so that's right consistent with how we manage the overall portfolio.
And Jason, you may want to mention, because we did discuss it a little bit, why it's so much better to be in individual bonds rather than a mutual fund or an ETF.
Yeah, that's a good point. So we've been preaching this for a long time, and I know you've spoken about that with your clients, but a lot of people feel safe in a bond fund or some type of bond ETF, exchange traded fund. And the problem with those types of vehicles is they don't actually have a maturity date. A lot of people think, well, they're fixed income, they're bonds, but it's actually a packaged product. And what I mean by that is they buy a bunch of bonds and it's in an instrument that you're purchasing. But as an investor, you don't actually own the individual bonds. We like to say it takes the fixed income or the fixed out of the fixed income, because you can't just hold a mutual fund or an ETF until maturity, because like I said, there's no maturity date. So owning the individual bonds, although you may have some volatility and the price may go up and down during the holding period, you as an investor get to decide when you want to sell that bond, if you ever want to sell it, but you sell it when it's to your advantage. And then your worst case scenario, if you will, is you actually can hold the bond to maturity and get all your money back. I can't think of any other instruments really where you can actually do that in investing.
No, it's true. Yep, exactly. So perhaps we could talk a little bit about the Federal Reserve and a recent interest rate increase, Jason. And I think after that, I think we're going to talk about where the yield curves are, and you have some exhibits for us as well on that. So
sounds good.
Sure.
Yeah, actually, last week, first, the fixed income's been pretty boring for a long time. The stock market's gone up for I don't know how many years now, and nobody really cared about fixed income too much. Although we all know that it's a very essential part of a portfolio as a stabilizer. Yes. What happened last week is the Federal Reserve had their regular meeting, and a lot of people expected them to raise interest rates 50 basis points, which is also 0.50%. They surprised the market and actually raised 75 basis points. So some people were expecting 75 basis points or 0.75%, but a lot of people were not. They were expecting them to just raise 50 basis points and maybe talk a little bit about their expectations for inflation and some of these other parts of the economy that are pretty painful right now for a lot of people. The reason the Fed did that is they are very concerned about inflation. The recent inflation number came in above where they were expecting. If you're the Federal Reserve, that's the last thing you want. You want the number to come in the same or go lower, because their whole mandate is to get us down towards 2 to 3% inflation as opposed to 8, 9 or something higher. So, excuse me. So that was a big surprise to the market. The market responded as you would expect, slightly negatively. But more importantly, we look at the expectation of what are they going to do next. And so they're talking about another 50 basis points at the next meeting and potentially another 50 basis points at the meeting after that. So
next meeting is when, July, Jason?
I believe so. I actually have these dates written down here. Let me grab it real quick. Yes, July 27th specifically. Okay. So, just as a reminder too, the Federal Reserve just controls the short end of the curve. And what I mean by that is really short-term investments. When we look at inflation, the reason inflation is a concern is because it affects everyone in their energy prices and food prices and things like that. But it also can impact the yield curve on the longer end, meaning longer maturities, 15 and 20-year maturities or longer. So,
well, and perception of high inflation becomes embedded in people's perceptions, and that affects the longer parts of the yield curve. Inflation it adds a lot of distortions to the economy as well.
Absolutely, it's very painful for everyone. So the Fed is very focused on trying to resolve that issue. Whether they'll be successful in the short term remains to be seen, but they are very concerned about it.
I think they've been more reactive than trying to get ahead of things, Jason.
Historically, the critique of the Fed is that they act too slow, and then when they do act, that they overreact. that they move too aggressively. There's a lot of really smart people right now who think that that's the case here as well. I think it's easy to point fingers. I'm not trying to defend or critique Jerome Powell, but if you can only imagine sitting in his chair, trying to lead the Fed and make these decisions, it's extremely difficult. It's not, there's no simple answers. What's that?
No, thanks for that job.
No, even last week, what he did with, raising 75 basis points instead of 50 basis points. I mean, that's what it threw the markets a bit in a tizzy because nobody expected that. And they knew that it was going to create conflict, but they felt that strongly that they needed to do that.
And I think in the stock market, I think the feeling now is we might be headed toward a recession. And I think that's why the market's been reacting the way it has. And of late, we've even seen some high cash flow companies or have with stocks with low price earnings ratios actually go down a lot. And that, I think the feeling there is that their profits could decrease if we go into a recession. And so even high cash flow companies could be impacted. No one knows that for a fact, though, but I think that's what the market's kind of saying right now. So, Jason, perhaps you may want to go over the maybe the yield curves and show actually some of the pretty decent rates out there on municipals and some other things.
Absolutely. Let's share my screen here for a second. Okay, are you able to see my screen?
Yes.
Okay, excellent. Let's see if we can move it down here. If I move it down, can you still see it?
No.
Okay. Oops. Okay. So I wanted to share this with you. This is a weekly piece that we send out to all of our clients. And for a long time, fixed income has been really uninteresting. Rates have been really low. And so I've been kind of pounding the table recently with the pain that we've felt in the bond market. It's created some more opportunities, some more attractive opportunities. And so the sheet that I'm sharing here, I think there's 7 pages or 6 pages. But what we do is we start with the simplest, most risk-free asset, and that's treasuries. And so if you look on the left-hand side, the US Treasuries, the 3-month, what's called the T-bill, right? And then out to 30-year Treasuries, you'll see that we go from 1.75% for a 3-month T-bill, and the 30-year Treasury is 3.4% right now.
So there's actually a slight inversion there then.
Yeah, so you'll see there's some slight inversions, and every day when we run this, it actually, some days will be inverted by 10 basis points or 15 basis points or 0.10% or 0.15%, which for stock people is like, what's the big deal? But in the bond world, that's actually a big difference. But you'll see there are some slight inversions like Steve just mentioned, from the 10-year at 3.43, you'll have the 30-year at 3.40. And so as an investor, you think, well, do I want to lock my money up for 10 years at 3.43 or 30 years at 3.40? Why am I getting paid less to lock my money up for 20 more years? And the reason is it's simply the inversion like Steve mentioned. And historically, it's not always the case, but historically, when you have inverted yield curves, it can tend to lead to recessions. So that is one big topic that you're going to see in the news, and Jerome Powell and others will speak about this. Is the last thing we want is an inverted yield curve, because it can be an indication that recession is around the corner.
And Jason, if I could just focus on us a little bit on the left-hand side, that left bottom quadrant there, we can see that last year's yield curve, the yellow line, is really the much more what's considered normal yield curve, where interest rates continually increase as we go out in the timeline. And you can see that the gray line of last month had some flatness to it in the later periods from 3-year to 10-year. But what Steve's talking about with the inversion is actually, you can see almost a hump where at 3 years, it looks like it's kind of like the maximum amount and then starts going down a little. And that is concerning a lot of people because it's an indication that the economy may not be as healthy as it should be. My question would be, though, why would we even buy a 4-year at this point? 3 years looks like the optimum purchase.
That's a great question, Laura. You're exactly right on your observations there. And to your question about 3 years, part of it is, it goes back to my point that I made a little bit earlier. You can observe the treasury curve or any other curve, and it's a data point, but we also don't want to get it wrong. And so when you think of a portfolio of bonds too, you want to have a little bit of everything in different quantities, depending on the strategy. For instance, if you're focused on interest rates going up, your duration might be a little shorter than it normally would be, anticipating that rates would go up. But to your point, yeah, you probably want to limit, in this scenario, you'd want to limit some of your longer bonds, 15, 20-year bonds, but you also do want to have some in case we're wrong and the yield curve does shift back down to the yellow curve. I hope it doesn't, but if it shifts in that direction, the longer bonds with the longer duration are going to help you, and they're going to significantly outperform. So you wouldn't, just like anything else, you wouldn't want to buy all long bonds. You wouldn't want to buy all short bonds, except for, if you had a really big cash need and you had to be all short. But when we look at portfolios, it's a combination of different maturities, different call features, and we structure the portfolios such that they're expected to perform over a wide range of different possible scenarios.
And one thing that's, when you calculate yield to maturity, that there's an underlying assumption there, and that's that the coupons that you receive on the bonds is reinvested at the same rate as the yield to maturity. And that's not always a great assumption. And so what can happen is, as you're getting a coupon, if interest rates are rising, you actually yield to maturity the reality is it could be higher than what you've originally estimated it was. So, or vice versa, if interest rates go down, it could actually be lower.
And so if you look to the right here, this is just a 10-year treasury yield history. I'm sorry, it's the 10-year maturity over the last 12 months. So what you'll see is we were in the 1.5% range back in June of 2021, I guess exactly 1 year from now. And you'll see we're now in the 10 years 3.43. So we've more than doubled. And interest rates have gone up 150 basis points or more. And that's a pretty extreme move in 12 months.
It is.
So if I could just say it another way, what you were saying, Jason, if you don't mind, is that even though the 10-year doesn't look to be, when you're looking at the left-hand side, as appealing because it might even be going down, to lock in that rate for a 10-year period could pay off over the long run if the entire thing shifted down. And that's, I think folks sometimes forget because they're so focused on just the immediate and not on the long run picture.
Absolutely. No, that's a great point. And historically, I don't have the data in front of me, but historically, over 100 basis point move in 12 months is a big move. So a lot of people who have gotten used to fixed income providing a consistent, steady return or income in their portfolio, this year, 2022, from January until today, has been quite painful. And just to put it in a historical context, this isn't the norm. This is a very abnormal environment that we're in currently.
And that's had an extreme effect on the net asset value of bond mutual funds and bond ETFs as well. Their net asset values decline. Many of them have declined dramatically because of that rate change. And it's going to take a long time for those people to recover that decrease in net asset value through yield on those funds and ETFs.
And not to be too negative, but it's possible they never could.
Exactly.
I mean, I'm not saying that would happen, but it's possible that it never could. Whereas again, with individual bonds, you can hold the maturity. And I don't want to get too deep in the weeds, but if you're holding a bond to maturity, as it approaches that maturity date, it's going to approach its par value.
That's right.
So let's say you have a really extreme scenario where your bond price, you bought it for 100 and it went to 89. That's not fun. Nobody's enjoying that process. But as you hold that bond over time, that price is going to go up just from the simple fact that it has to mature at par or 100. When I say par, that means 100 as a dollar price. So you don't experience that with an NAV. It doesn't go back to the original NAV that you purchased it at. And if rates continued like this for another 10 years, rates continue to go up 100 and then another 100, you might never get back to that NAV. I'm not saying that's going to happen, but that sounds like, creating fear, but you're just not ever guaranteed that you're going to get back to that original. Yeah, it's just a simple math.
So again, just to interrupt, Jason's clients are all institutional clients and they all know what an NAV is. that maybe all of our clients don't know what an NAV is. So really what Jason's talking about is the difference between being in an overall bond fund that has moved, or an ETF that has moved. Maybe the valuation has come down because the bond fund manager was forced to sell and they've locked in that lower valuation of the bond pieces.
Yep.
Whereas we already know when we buy these bonds that we already know where we're getting your cash from. We're not selling these bonds in a downward market. We only sell when there's opportunity to potentially improve the quality of the bond, not to lock in the loss. So
That's correct.
That's really what Jason's talking about.
Yep.
Absolutely. So the first page is just treasuries. It's the safest asset you can think of, right? The government is paying you to buy these bonds. So as we go to the next page, this actually talks about spreads. I don't want to necessarily cover that today for this purposes of this call. But the third page here that I'm referring to is tax exempt municipal bonds.
Right.
And so if you think of tax exempt municipal bonds, it's just, I haven't met anybody yet who really likes to pay taxes. So when you think of tax exempt municipal bonds, you're not paying federal taxes on the income on these bonds. And so if you look at the tax exempt municipal box here in the top left, the maturities are listed here, 1, 3, 5, 7-year maturities. And what you'll observe is those are the yields on the bond. Now, these, for this purposes of this slide, these are AAA, they're the highest quality. Typically, given our expertise and different strategies, we can buy different bonds that provide better yield and still provide almost the same safety. But just for example purposes, you'll see here, we'll just pick on a 7-year maturity right now. But for a general obligation bond, and I'll explain that in a moment, it's a 2.65% yield. And for a revenue bond, it's 2.86% yield. A real brief, quick explanation between the differences. A general obligation bond is if you live in a town in Texas and you pay your real estate taxes, those real estate taxes are backing a general obligation bond. There's multiple examples, but that's just one simple example. They're very high quality, very good opportunities as investors because everyone in that area pays their real estate taxes. If 1 or 2 people don't, they lose their house. So they have governmental authority to make sure that bondholders are paid. And that's very, very important as opposed to other things. For example, if you have a bond that has a baseball stadium parking garage, and that's how you're getting paid. If the baseball team does well, you get paid. But if the baseball team doesn't do well, you're not getting paid. We have zero interest in investing in those types of bonds for high quality portfollios. When we
By the way, Jason, we were talking about the default rate overall in municipals over the last, 30, 40 years, right?
Yes.
It's exceedingly low, right?
Moody's does an excellent job. They have a report that comes out and they show their data on 30 years of fixed municipal bond credits. And the default rate for AAA, AA is, I want to say it's almost zero. It's 0.03% or something very, very low. It's almost zero. And then even when you go down to single A, I think it's still below 1%. So, when you think of the context of the markets, 1% or less default rates is just incredibly, incredibly low. They're very.
And I want to mention why that's so important from our view is that we don't really have to diversify, but in other words, for each maturity within, tranche within our portfolios to buy 30 different bonds. We can just buy 2 bonds, for example, because we're not really concerned with diversification as much because the default rate's been so low historically.
And let's compare that to corporate bonds, Jason. A default rate for investment grade municipal versus a corporate.
I want to say the last time I looked at the data, excuse me, it was around 6 or 7%, I believe. Might be a little higher than that, which still is not significantly high, but much, much higher than when you compare them to municipal bonds.
And then
it means that
yields,
we would have to diversify among those.
Right. And then high yields.
High yield was in the double digits, so 15 to 25%, depending on how you're looking at it. It gets much more complex because there's layers as you get into credit and things. But yes,
yeah. And the problem
why
is
did you be called junk and not high yield?
They always default at the wrong time.
When they're defaulting, it's really hard to get a bid. You'll be in the market trying to find somebody to buy them, and surprisingly, everybody goes away when it's getting really ugly. So exactly when you need them and you want to get out, it's very difficult. So I believe there's very talented managers who can handle those types of solutions. but that's not what we're interested in. A lot of what we do for our clients is it's the high quality, mostly boring part of the portfolio. I say mostly only because this year's been a little tricky with the overall macro environment, but these portfolios are meant to be very boring. You collect your coupons, they do exactly what we want them to do, and they perform when we need them to perform.
But from our view, it's a reservoir of wealth a client can tap into, even in the worst market conditions. That's our view.
And that when you're talking about high quality like this, there's always a bid in the marketplace, a good bid. Very rarely do you not get a good bid on high quality municipal bonds like this, because there's demand. There's demand for high net worth institutions and individuals who want to own these bonds. So, but real quick before I forget, so revenue bonds as comparison to general obligation bonds, when we're talking about revenue bonds, it could be any type of revenue source, but what we typically focus on is essential revenues. And when we say essential revenues, we're talking about water and sewer revenues. And what that means is when you pay your water bill for your house, that revenue, that money goes to the bondholder. So very few people are going to say, I'm not going to pay my water bill. Just try to go a day without your water turned on. You know, they're going to pay their water bill or your electric and light bill. So those are the type of revenues we're talking about. Again, not a stadium, not a special project that may or may not pay us. We're interested in, bonds that have governmental authority and we're going to get paid.
Stunning when you look at the tax equivalent yield now on munis. The general GOs is 7 years over 4%.
Let's talk about that for a minute, because actually we make a big deal about understanding every single client's marginal tax bracket.
Yep.
A lot of people understand, okay, we want to understand that before we recommend a Roth conversion strategy or whatever strategy. I don't know if people realize that this comes into play also when we're shopping for bonds.
It does.
Absolutely. Because it makes a big difference. To your point, Laura, it makes a very big difference. On this sheet, you'll see the left box is 24% federal tax bracket, and then the right box is 37% federal tax bracket. So you'll see, if we just pick on one, for instance, let's say it's a 7-year maturity, it's a general obligation bond, it's 3.49% as a tax equivalent to that investor. If I'm in the higher bracket of 37%, it's actually a 4.21% equivalent to me. So you can see there's a big difference there. Just doing rough math, but let's say 70 basis points of difference. And this is just looking at municipal bonds. Think about corporate bonds, CDs, taxable munis. There's a bunch of different other options we can consider. But to your point, Laura, the tax bracket is everything, right? Some people say, build me a municipal bond portfolio or build me a corporate bond portfolio, but they're not even talking about the client's tax bracket, federal and state tax brackets and state residents.
The thing is that this is not reflective in the performance that our clients are evaluating us in. A lot of times it's outside of that performance that they actually see the ramifications or the impact of it, but it's the right thing to do. And as fiduciaries, that's why we make a big deal about understanding that tax implication.
And I want to mention, because we do go over this information with Jason for our clients when we decide what type of bond to buy. Sometimes I've seen the investors that are in the wrong type of bond fund. Even they're in a tax-free when they shouldn't be because their tax bracket's so low. So that's another area of expertise we have here, is knowing what your tax bracket is and what type of bond should be in your portfolio, and also by what type of account it is, to IRA versus taxable, of course.
I'm sure you see it all the time, but we see client accounts that come in that have been at some of the big wirehouses and things, and it's shocking. Some of the portfolios we look at, it's just wrong bond, wrong portfolio, just wrong. So
but they had an inventory.
Yep, absolutely.
Yeah,
that happens many times. But one more point on this slide is you can see the tax equivalent yields are quite attractive.
They are.
Historically, when we've hit these levels where the tax equivalent yields are at these levels, there's a lot of buyers that step into the market. We work with a lot of institutions, banks, insurance companies as well. And when municipal bonds cheapened up recently, a lot of demand came into the market pretty quickly. So it's like any other market, the inefficiencies sometimes correct themselves in moments or within the day. Not saying there were inefficiencies, but it was a big move. And so there have been some big buyers coming back into the municipal market. But as we've spoken about, I don't know if the bond market's going to continue to sell off, or if, we may sell off another 100 basis points, 200 basis points. I think we're in a very uncertain environment, but I do know when I look at the data and I look at what we see in front of us today, it is a good opportunity to put some money to work, especially if there's been some fixed income assets on the sidelines or sitting in cash.
Yep.
If you're going to invest $1 million eventually, maybe you put $200,000 of it to work now and then kind of see what happens.
Yep.
Because there is a real point that maybe this is the top, maybe the pain has been felt, but again, we don't know. That's why we stress test and look at a variety of scenarios.
And which is why you structure it and buy different maturities for that very reason, as Jason mentioned at the very beginning of this talk. Yep.
Yep, that's correct.
Yeah. And so I just want to mention again that Jason really only deals with institutions, investment advisors and banks. He doesn't deal with individuals.
And I probably also would like to mention that while Jason is probably one of our favorites to deal with, we don't work for him. He doesn't work for us. And we do have access to other bond houses as well. We tend to give more business to the organizations that do the best for our clients. There's no other reason for us to use Jason, and he just keeps coming through with helping us do the best for our clients, which is one of the reasons why he's our favorite.
That's correct. And their pricing is very good. We get institutional pricing and the markup on the bonds. It's quite low. And we do analyze it, look at it. And they actually, Jason's firm sends us a report showing us a transparency report.
And just real quick on that point, we are not required to do any of those things. Our competitors do not disclose those things. It's part of our culture. So at the end of the quarter, they receive a transparency report that has every trade that you did with us, what we paid for it, what you paid for it, and the agreement is 10 basis points or less, 0.10. For historical context, we can't share the data, but historical context, that's in the bottom quartile of all bid offer spreads in the marketplace. Sure. And what I mean by that is every company, whether it's Vanguard or any other big bond house, they have to buy their bonds somewhere. So they pay a bid offer spread, and nobody knows what it is. But we can confidently tell you the 10 basis points you're paying is in the bottom quartile. And then we also have an execution report, which shows the context of the market. So the day you bought the bond, the price of the bond, but also the other prices that were in the market that day as well. And that's another report that nobody provides.
That 10 basis points is well worth it for the expertise that we're getting here.
It's not just the expertise. It's that. So when he says bid offer spread, again, he's talking about what they buy it for and then what they sell it to us for.
Right.
So they actually buy it and they're inventorying it in their own space. And they have that gives them the ability to say, no, this is right for this client. It's not right for that client. What happens in these larger institutions that many people know the names, they're big top names, they buy it, they inventory it, and then they give it to you just because that's what they have.
That's what they have holding.
By paying that 10 basis point spread, we're able to be picky and choosy in terms of what we're willing to put in our clients' portfolios. And that's why it's well worth it.
And I want to mention that too, because sometimes we'll send Jason a request for bonds. And as a client, you may not see that fulfilled once we rebalance your portfolio for a couple of weeks sometimes, because Jason is he's being careful about what he picks. And that's what that expertise is really important to us. And not buying it right away necessarily, finding good deals and relying more on good deals than speed.
We work with 300 or more counterparties. And what I mean is we work with all the big boys, all the small boys, everybody in the marketplace, but we don't inventory or we don't underwrite either. And because we believe those are conflicts. To this point, if we underwrite a deal, our obligation is to the person we're underwriting for. So the city of, fill in the blank. Sure. It's not to you, but we feel like the way we're structured, we are on your team and we work for you to get best execution and to not be biased to try to sell one bond over another. The hardest part is picking the strategy. The hardest part is figuring out what strategy do we need for this client, making sure we have the right tax bracket, state of residence, all those things. Finding the bonds is quite easy, quite frankly, the easy part of it, in our opinion. So,
great. Okay.
Okay. So is there anything else that we should talk about, Jason, I think we've offered a lot to our clients. Is there any parting words that you have?
Not really. I think the one thing I would say is, we're in some scary times now a little bit. I mean, the markets are a little volatile and it's creating some tension. I know it is for me. At some days I'm thinking, what is going on? Or does the Fed have this under control?
Sure.
But we've been around these markets for a long time, all of us, and we know that they come back, and we know that things get more rational. And so, I think my encouragement would be, especially when it comes to fixed income, don't try to predict the Fed, or don't try to predict where rates are going. Stay disciplined to your strategy and what you're trying to accomplish, and stick to high credits. A lot of people, I get a lot of calls, as you can imagine, not recently, but when rates were really low, a lot of people were trying to compromise on their credits, and trying to go for lower credits and searching for yield. Just be really careful to not chase yield. That can be a very dangerous move. Sometimes it makes sense to buy the lower yielding bond because it's going to provide the defense in the portfolio that you really need for times like these. So I guess that would be my one takeaway as we approach whatever lies ahead in the next months and the rest of this year.
That's great advice. And we can extrapolate that out to all the markets that we invest in to, it's the same thing. So thank you for those very wise words. So thank you so much for spending the time with us. It's really important for, our clients don't have access to people like you directly. And so being able to offer them the opportunity to hear from experts like you is really important to us.
It is.
So thank you for joining us.
It's my pleasure. Thank you for having me.
Absolutely. And to our clients, thank you for listening. And if there's anything that you have in particular that you want to talk about, as always, we are available to talk to you. So please give us a call. Bye. Have a great day.